The first painful truth is this. You were taught that wealth comes from hard work, patience, and earning more. The second painful truth is that markets also reward something else entirely. Not growth, not innovation, not management. Sometimes the easiest way to take money is to bet against the collapse and get paid while everyone else panics. And here is what nobody wants to say out loud in 2026. While you are trying to secure a job from AI, while your rent climbs faster than your wage, and while inflation came down on paper, there is a class of professional traders who profit when prices fall. They don't need your belief. They don't need your approval. They only need one thing: a market that is already unstable, already overpriced, already doomed to reprice, and then they push. This is not financial advice. This is financial education, the kind that makes you uncomfortable because it turns your emotional comfort into a chart. Today you are going to learn what short selling really is, how it works mechanically, why it can accelerate downturns, and why your entire financial education has treated it like some forbidden dark magic. You will also see how the same logic shows up in the real world beyond stocks, foreign exchange, leverage strategies, and even how institutions can harvest panic during housing stress and credit stress. And before you switch off, remember this, because you will need it later. In every era, when society starts screaming about greedy speculators, the people quietly making money usually are the ones who understand something simple: that markets don't fall because of emotion, they fall because of positioning, liquidity, leverage, and forced selling. And short sellers know how those levers work. Now let's start with the core concept. Short selling is basically a bet that something will go down. But the way it is executed is what makes it more dangerous than it sounds. You are not buying a lottery ticket. You are not placing a hope trade. You are actively borrowing the asset, selling it at the current price, and then later trying to buy it back at a lower price so you can return it. If the price falls, you profit. If the price rises, you lose. Simple on the surface, brutal in practice, because the loss math is not bounded the way it feels for most beginners. Most people hear the words and assume it is like gambling. It isn't. It is closer to real estate leverage, insurance, and industrial scale risk arbitrage. Except you are betting on human behavior during stress. And in 2026, stress is constant. AI is displacing jobs faster than the training promises from 2020 ever could. Central banks keep adjusting rates with one hand while inflation still chews through purchasing power with the other. Housing is decoupled from wages across the United States, the United Kingdom, Canada, and Australia. And every time people get squeezed, they sell, they liquidate, they borrow again, they default. And the market becomes predictable if you know where to look. But understanding this is not enough, because the first myth you need to kill is this one. You think short selling is rare and professional only. You think it is something only hedge funds do. Yet the actual reason most people never learn it is not complexity. It is psychological defense. Most people don't want to admit that markets contain a strategy that profits from their fear. Let's talk about why it is called a dark art in the first place. Short selling is sometimes described as going against the crowd, but that is not the real reason it is feared. The real reason is that short selling attacks the part of the market that depends on confidence. When a stock is rising, people pile in for emotional reasons and momentum reasons and FOMO reasons. When the story breaks, there is a moment where the market flips from optimism to survival. Short sellers don't just want the story to fail, they want the failure to become self-reinforcing. Here is the mechanism most people never get taught. When you buy a stock, you usually think you own a piece of a company. In many cases, you own beneficial rights, and the custody system sits in the background. The point is, the market is not arranged like a vault with your name on it. Assets are held through intermediaries, and shares can be lent out for trading. Short sellers borrow shares from brokers or custodians and sell them into the market at the current price. Then, if the price drops, they buy shares back cheaper and return them. The difference is their profit. Meanwhile, the act of selling borrowed shares increases supply at the moment when the crowd is already fragile. Now add this layer. In modern markets, short positions are not just a simple trade, they are also pressure. Because short selling is not usually blind, professionals research. They look for overvaluation, accounting weaknesses, weak business models, fraudulent narratives, regulatory risk, and leverage traps. When they believe a price is disconnected from fundamentals, they can sell short into the market. If they are right, price declines reflect repricing. If they are loud about it, rumors and negative catalysts can accelerate the repricing. That acceleration creates forced selling among others. Not because short sellers magically cause the fall, but because markets operate through constraints: margin calls, liquidity needs, and risk limits. And in 2026, these constraints are tighter than ever. Think about what happened during the rate environment since 2022. The Federal Reserve raised rates to fight inflation.
And even when headlines began to soften, the real story for ordinary people did not magically reverse. Real purchasing power still took damage. Many households found that their salary did not keep up.
Meanwhile, the cost of borrowing increased for anyone using credit cards, car loans, or variable mortgages. Then AI came for the middle, not the top. Middle skill work faced automation and job redesign, and job security became a bargaining chip people didn't have. When people feel insecure, they sell what they can. They reduce risk, they liquidate portfolios, they stop investing, they stop holding speculative assets. The market doesn't need a villain, it just needs leverage to unwind. But here is where you should feel the cold anger, because it connects to your life. You were taught that buying is safe and selling is reckless, yet in 2008 and again in later corrections, it was the leverage and the promises that collapsed. And the people who profit were not those who believed hardest, they were those who understood the fragility earlier. Now let's do a pattern interrupt. Pause for a second and ask yourself a question. Why does every economic downturn come with the same media narrative? People are overreacting. Markets are irrational. Buy the dip, it will recover. And yet while headlines say recovery prices for housing stay high and real wages struggle. Why does the pain spread across normal people while asset holders recover faster? The answer is not comfort. The answer is structure. Short selling is one part of that structure. The broader part is this. Financial systems are built to concentrate leverage, reward speed, and penalize slow decisions. Short sellers are like speedboats in a flood. If you are still thinking this is just about stocks, you are missing the darker understanding. Short selling is also about currency. And in 2026, currency stress has a direct relationship to energy costs, imported inflation, and global debt management. This brings us to a more specific story. In the early 1990s, the United Kingdom fell into economic trouble while other countries managed rates differently. Interest rate policy is not just numbers on a central bank calendar, it determines relative capital flows. It determines whether investors move money toward a currency for yield or move away due to risk. There was a famous case where a trader recognized a divergence. When one country cut rates while another kept rates higher to fight inflation, the higher rate currency tended to appreciate. That is the simple engine behind many currency trades. A professional trader can borrow one currency and sell it, while simultaneously buying another currency expected to strengthen. In foreign exchange terms, that is a long-short strategy. You are shorting one currency and long another, effectively making the bet on relative value. Now, does that mean traders control governments? No. But it does mean they can amplify existing weaknesses. If a government tries to defend a currency by raising rates in a recession, it can break the economy. If it does not raise rates, the currency weakens and imported costs rise. Either way, the public pays. And that is why currency short selling is terrifying. It feels abstract. Yet it turns into real bread prices, real energy costs, real consumer panic. Here is the cliffhanger in your mind. If this is how it works in currency, what happens when the same logic is applied to a highly leveraged asset class like housing and credit? Before you answer, remember the second half of the earlier claim. Short sellers don't just profit from falling prices, they often profit from the cascade created by forced repositioning. In housing and credit markets, forced repositioning is constant because leverage is embedded everywhere. Mortgages, credit lines, student debt, auto financing, corporate debt, commercial real estate exposure, insurance solvency pressures, all of it is connected. Even climate-driven disruptions now show up in insurance markets collapsing in certain regions and increasing migration and relocation costs. When insurance becomes unaffordable, property becomes less liquid. When property becomes less liquid, financing becomes harder. When financing becomes harder, prices can drop, and when prices drop, leverage unwinds. You can see why short selling is not just trading, it is a bet on systemic weakness. Now let's escalate. How does a professional short seller actually find a target? Here is a brutal principle. The best targets are not the obviously broken companies. The best targets are the businesses or assets that look fine to the public, but are fundamentally hollow. Most people in mainstream finance look at outcomes you can measure today: revenue, brand popularity, market share, price charts. Professionals look for contradictions. Revenue that does not reconcile with cash flows. Growth that depends on aggressive incentives that will collapse. Accounting that makes earnings appear stable while debt rises off balance sheet. Customer metrics that cannot scale without fraud or dilution. And professionals look for something else in 2026 that many casual investors ignore: ownership behavior. If founders and executives are still buying heavily, you might assume confidence. If they suddenly sell most of their holdings near highs, you might assume an exit. You can find those changes in filings and transaction disclosures. The public sees a stock as a bet on the future. Insiders may see it as a chance to convert paper wealth into real money before the repricing. So here is where you get empowerment with a warning label. You can learn to observe. You can learn to ask whether the people with the most information are behaving like long-term believers or short-term exit artists. And in markets, exit behavior is a signal. Now another pattern interrupt, because this part matters for your survival in 2026. You are not competing with short sellers when you invest. You are competing with the market structure itself. The structure is designed to reward those who act early and punish those who act emotionally late. Remember what you were told during inflation: just invest for the long term. People heard it as comfort. But long term can also be a weapon. If a bubble inflates and then reprices over years, a long-term holder may still lose massively in real terms. Meanwhile, a professional who shorts the bubble at the right time can lock in profits before the public even recognizes the story has changed. In other words, your time horizon is not a shield. It is often a delayed trap. Now let's go deeper into the risk and the part nobody explains honestly. When you short a stock, you borrow shares. You are required to return them. And because you borrowed them, you pay a fee. That fee can rise when lots of shorting demand exists or when borrow supply is tight. This creates something beginners underestimate. You can lose even if the price never moves much. Then there is unlimited risk. If the price rises significantly, your losses can rise without the same ceiling as your upside. If you buy a stock and it goes to zero, you lose your investment. If you short a stock and it doubles, it can keep rising. There are cases where short sellers lost more than their initial capital because of margin calls and forced covering at terrible times. There is also a psychological trap. In a rising momentum market, your short thesis feels right until it doesn't. You can be correct long term and still lose short term due to squeezes. So the question becomes, how do professionals survive? They do three things. They pick cases where they expect downside to arrive before they are forced out by fees and squeezes. They use risk limits like predefined exits, and they structure hedges when the underlying volatility could hurt. Now, in the original logic you were shown, there was an emphasis on cutoffs. The same idea applies here. Professionals set maximum loss thresholds and accept that no thesis is perfect, because the dark truth is not that short sellers are always right. The dark truth is that markets are always punishing you for being wrong, and professionals manage the punishment. Now let's talk about why short selling is often treated like a moral crime. The public hates it because it attacks the comfort of upward price narratives. When you own an asset and it falls, you feel personally betrayed, and so people blame the trader, the institution, the hedge fund, the Soros headline, the Wall Street villain. But the more accurate way to understand it is this: short selling is not the origin of collapse. It is a force applied to collapse that is already becoming inevitable. The collapse has to exist first. That is the difference between conspiracy and mechanics. A bubble can exist because capital flows and optimism ignore fundamentals. A bubble can inflate because of low interest rates and easy credit. A bubble can keep inflating because new buyers chase momentum. Then eventually something breaks. A growth assumption fails. A policy changes. A rate regime tightens. A recession starts. Cash flow weakens. Debt matures. A liquidity buffer disappears. Short sellers don't create that weakness from nothing. They exploit it at speed. And when they do, the public only sees the final stage. Prices crash. They never see the earlier stage. The asset was already fragile. Now you need a real 2026 connection, not a history lesson. AI disruption is pushing labor markets into a new kind of volatility. Many roles are being redesigned. Some tasks are being automated. Some people still have jobs, but the wage growth stagnates. This is a slow squeeze that looks like stability until suddenly it becomes a crisis. Then it becomes layoffs, reduced hours, delayed hiring. Housing is the other squeeze. Housing prices across major Western cities have detached from wages for years. That means household budgets are forced to allocate more to housing. In a rate shock environment, affordability worsens and the resale market becomes thin. Insurance costs add another layer. When insurance markets collapse in certain regions due to climate risk, property risk becomes higher. That can affect underwriting, lending standards, and appraisal values. Now connect this to short selling logic. If an asset class becomes overpriced relative to fundamentals, and if leverage makes everyone dependent on continued price support, then the downside becomes self-reinforcing. That is how bubbles become crashes. But your brain might resist this because it sounds too deterministic. So let's add a micro story that feels like something you might have lived. Picture a 38-year-old nurse named David. He works nights. He picked up a second shift because he wanted to buy a home. He listens to personal finance podcasts that tell him to stay invested, diversify, and ignore market noise. He finally finds a condo listing that seems affordable on paper, because listings look like bargains compared to the price mania of prior years. Then he gets approved. He celebrates. He signs. He thinks he beat the system. Fast forward a year, interest rates haven't returned to the easy money fantasy. His budget is squeezed by food and energy costs. His take-home pay buys less than it did in 2019. Then a job stress hits his household. A relative gets sick. He needs cash. He lists his condo. He waits. Weeks pass. Offers come in low. Buyers hesitate because they assume prices will fall further. Meanwhile, lenders tighten standards. The market stalls. David doesn't see the connection to short selling directly. He just sees a stalled market and unfriendly conditions. But the underlying truth is this: when the market expects repricing, everyone behaves cautiously. Liquidity disappears. Price discovery becomes brutal. And now here is where the cliffhanger becomes personal.
If you were a professional trader looking at the same data, you would see a pattern: overpriced assets under leverage, forced sellers in the background, and risk limits tightening. Short sellers profit when the cascade begins, and David's real-life hardship becomes part of the market's repricing machinery. You are not the only one. In 2026, the squeeze is broad. Now let's address the most modern twist people still misunderstand: crypto. Crypto was marketed as freedom from banks and freedom from institutions. The pitch was narrative: decentralization, digital scarcity, passive income myths, and don't trust the system. Yet in 2026, regulation and institutional integration have changed the game. Banks and large funds own more exposure to the crypto market structure than most retail investors. When crypto crashes, the losses do not just vanish into the ether. Exposure is hedged, liquidations propagate, and institutions reposition.